We're going to get Wholesale now from Rick Santelli, who's at the CME in Chicago. Rick, the numbers, please.
Yes, on the PPI for the month of October, expecting up 0.1. Buckle up, down 0.5%, down 0.5%. That is a huge drop. You have to go way back to April of 2020 to find a smaller month-over-month change, and that one happened to have been minus 1.2. And if we look at what is going on with regard to ex-food and energy, unchanged, also significantly lower than up 0.3. Ex-food, energy, and trade up 0.1, half what we were expecting. Year-over-year numbers now. Final demand 1.3, a huge drop from 2.2. 1.3. That is the lowest level going back to July when it was 1.1. And if we look at 2.4, if you subtract food and energy, that's 0.3 less than we were looking for. You'd have to go back all the way to January of 2021 to find a lower number. And finally, ex-food, energy, and trade, 2.9. That is the only metric that's higher than we were expecting. We're expecting 2.8, and 2.8 was in the rearview mirror. We had several 2.9s. We had them in July and August. So food, energy, and trade is a little stickier than expected. All the other numbers are cooler than expected. Let's look at Empire, shall we? Empire expected down 3 is now 9.1. 9.1, that's the best level going back to 10.8, which was April. Now retail sales for October, down 0.1%. We were expecting a down number. That's less than the down 0.3% we were looking for. And we made it up in the revision from up 0.7 to up 0.9. If you strip out autos, it's up 0.1. So we could see that autos, of course, affected the equation a bit, and stripping them out turns it up 0.2 into a positive 0.1. Rearview mirror, 0.2 of a revision from up 6 to up 0.8. Strip out autos and gas sales, also up 0.1. The control group is up 0.2, exactly as expected. That follows a revision from 0.6 to 0.7. What's notable here is all the revisions for September were positive revisions. We see that interest rates aren't moving much. As a matter of fact, we are now a couple of 30 seconds higher. We look at the futures. If we look at what's going on, 448, we're at 446 on the cash market. 487 on Tuesday. We're at 484. So what's going on? Well, I think that part of this is yesterday we probably had a bit of an overreaction to CPI. Understandable. Not only in the U.S., in the U.K. they had a better than expected number. And how over their skis did they get? Get this, Joe. They auctioned off 7 billion pounds of 20-year notes. They received 93 billion pounds worth of bids. 13 times more bids than the amount of securities for sale. That is unreal, and it really does underscore that central banks were very punishing. The notion that they're done, well, it's a big party out there. Now, whether this holds true, we're still a bit of a ways from our 2% target, and PPI cooler numbers didn't really garner a lot of market activity like CPI. The other thing we want to point to is that are we going to ever pay more attention again to supply or to term premiums? They didn't go away. We've just changed our focus. You always trade the market ahead of you, but that certainly doesn't mean that there aren't issues ahead, especially issues when you think about how governments around the world are trying to control more of their economies. That should affect productivity. But at least for the moment, inflation seems to have struck a chord not only with our central bankers, but also investors, interpreting those as very positive signs. Joe, back to you.
All right, Rick. Very good. Let's get to Steve Liesman. He joins us now with more. We're seeing, Steve, kind of a muted reaction. Did we get it all yesterday from the CPI, which makes this, was this not surprising? Still seemed like some of those numbers were surprising.
I think so, Joe. I think we got a lot of reaction yesterday, but I'm actually a little more excited about this number, in part because there are pieces of this PPI that feed into the Fed's PCE, which is their preferred indicator. So to the extent that some of those indicators inside it were low, it's also going to help the Fed believe in the decline in inflation. We've seen times when it's gone the other way. In fact, the PPI report has garnered a lot more attention these days because of what feeds into the Fed's preferred inflation indicator. And so these are good numbers. I'd point out that a big part of the decline here was the trade component, which is a profit component. They try to, a margin component they try to estimate from wholesalers. So that's a piece that feeds into it in terms of what's going on with the Fed's PCE. On retail, it's a good question now whether or not we've taken a break here after that strong number we had in September. I was surprised it was not revised lower. Or is this just the beginning of the slowdown that we've waited for from the consumer? Are they taking a break before the holidays, or does this augur poorly for the holidays? We're just going to have to watch that, watch the high frequency data and other data we have. But, you know, in terms of components, furniture was down 2%, autos were down 1%. We'll just have to wait and see whether or not this is the beginning of something or just a break they've taken from a strong series of consumer spending.